Basically, what they're saying is, earlier in the article, they're saying that they're not rushing to get rid of their treasuries, but very, very slowly and surely and methodically, they are reducing their treasury exposure for other short-term assets, and specifically mentioned here, short-term assets and gold, which is only 6%.
Yeah.
By the way, a couple of years ago, it was only 3%. So the gold exposure is increasing little by little every month.
Investors view the current valuation level of gold with skepticism. However, compared to previous bull markets, it is not exaggerated. After the Nixon Shock in 1971, the gold price rose by almost 300%, whereas currently, gold is about 120% above the level of January 2020. Speculation has persisted that China did not in fact ignore the Trump tariffs, but instead dumped substantial quantities of its U.S. debt holdings. China may be selling treasuries in retaliation, wrote Ataru Okumura, a senior interest rate strategist at SMBC Nikko Securities in Tokyo. Clive Thompson is a retired wealth manager with decades of experience in global finance and investment strategy. According to Thompson, China has been steadily increasing its gold purchases month after month, signaling a deliberate shift away from U.S. treasuries. The People's Bank of China has added gold to its reserves for 17 consecutive months, signaling strong long-term confidence in precious metals over U.S. government debt. As of early 2025, China holds less than $800 billion in treasuries, the lowest level in over a decade. While reflecting on the market, Thompson observes a growing trend of private investors turning to gold as confidence in equities wanes. Notably, the period between January and April 2024 saw especially strong gains, with gold rising by about $600 to $700. Some experts believe China may hold far more gold off the books, possibly over 25,000 tons. Former Chinese central bank advisor Yu Yongding warned that swapping treasuries for 100-year bonds in exchange for tariff relief could be a default. As of the end of January 2025, China held $761 billion in U.S. treasuries, making it the second-largest foreign creditor to the United States, trailing only Japan, which holds $1.08 trillion. A $50 billion sell-off represents a notable chunk, approximately 6.6%, of China's total treasury holdings. Before diving into Clive Thompson's sharp insights from his latest interview, hit that subscribe button and tap the bell icon so you never miss a moment when truth meets the market.
So I think we probably will go lower on the stock market. But there's an awful lot of people out there with cash on the sidelines, and they're looking to buy every dip. And I think there's a lot of people saying, if it dips, I'm buying. I mean, I've had many people write to me in the last 30 days alone saying, I'm holding cash and I think the market's going down and I'm going to buy the dip. So in a way, that's quite supportive of the market at the moment. But you never know. If we get some bad news, the market could plunge rapidly. But at the moment, it's holding up well. But I think that there is a trend of putting money into gold at the moment. Gold is holding up very well as well, and I think that along with the central bank buying, I think the private buying of gold is going to start to increase a little bit as the stock market fails to make all-time highs. But as if you scroll down to the part which says China ranks 6th in gold holdings, yet gold comprises only 6% of its reserves. Now, we're looking at the chart here that you're showing, Mario, and it shows the reserves as gold as a percentage of reserves in other countries, like Germany, 75% of reserves, Italy, 72% of reserves, France, 73% of reserves, Russia, 33% of reserves, China, only 6% of reserves. Switzerland, 10%, India, 12%, Turkey, 37%, Netherlands, 66%. So China is way behind the rest of the world in terms of amount of gold it's got in its reserves, but we are seeing that it is consistently, month after month, buying gold. And if you read a little bit, I think we should read those 3 paragraphs at the bottom, because it says, in words of one syllable, China is slowly but surely increasing its exposure to gold. I am deeply worried that the ongoing US-China trade dispute could spill over to China's foreign assets, said Yu Yongding, a former member of the Monetary Policy Committee at the People's Bank of China and a senior advisor to the government at a conference in early April this year. He cited media speculation about a Mar-a-Lago Accord along the lines of the 1985 Plaza Accord, based on an essay by Stephen Miran, now chair of Trump's Council of Economic Advisors. The aim of such a plan would be to weaken the dollar and persuade other governments to swap their treasury holdings for 100-year zero coupon bonds in return for more lenient trade tariffs. And then it goes on to say few in financial markets believe this plan will be implemented. But for you, it is still a concern. Such a swap would constitute a default, he argued. That poses a huge threat to China. Don't forget he's an advisor of the Chinese government on their monetary policy. It would pose a huge threat to China, and we may end up paying a steep price. So basically what they're saying is, earlier in the article, they're saying that China is, they're not rushing to get rid of their treasuries, but very, very slowly and surely and methodically, they are reducing their treasury exposure for other short-term assets, and specifically mentioned here, short-term assets and gold, which is only 6%.
Yeah.
By the way, a couple of years ago, it was only 3%. So the gold exposure is increasing little by little every month. And I'm waiting to see in a couple of days what the April purchases were like, but I've no doubt at all they were buying again in April. And of course, almost every month they're buying at record prices and they don't care. I mean, why should a central bank care if they pay a record price? Because all they're doing is swapping worthless paper.
Based on fundamentals, Clive Thompson says the 2026 U.S. budget deficit will see only minimal relief from new tariffs, likely adding just $140.8 billion in revenue, far less than the $700 billion claimed by officials. Thompson also mentions that if Trump's 2017 tax cuts are permanent, the 2026 deficit could balloon, pushing the total shortfall beyond 6.5% of GDP. On January 21, 2025, the Department of the Treasury announced a debt issuance suspension period and began taking extraordinary measures to continue financing government operations without breaching the debt limit. In March 2025, CBO estimated that if the debt limit remains unchanged, the government's ability to borrow using extraordinary measures will probably be exhausted in August or September 2025. President Donald Trump's 2026 budget plan would slash non-defense domestic spending by $163 billion, while increasing expenditures on national security, according to White House statements Friday. The White House budget plan arrives as Trump has unilaterally imposed what could be hundreds of billions of dollars in tax increases in the form of tariffs, setting off a trade war that has consumers, CEOs, and foreign leaders worried about a possible economic downturn. Let's get back to the interview.
Question was, what is going to be the effect of these tariffs on the budget deficit for next year, 2026? I mean, we're only going to have a partial effect this year. Now, first of all, the tariffs will bring in extra revenue to the United States. And the question is how much and how will that affect the deficit? Now, the deficit for 2026, according to the Congressional Budget Office, that's the official party or department which estimates what the level of debt will be and what the deficit will be. The deficit is when the government spends more money than it collects in taxes. So at present, and this is based on January's 2025 forecast, their forecast, that's the last forecast they made, they say that in 2026, there will be a deficit of 1,865 billion or 1.86 trillion. That, by the way, is a very large deficit. It's the biggest ever, I think. Maybe the COVID year was slightly higher, I don't know. But it's certainly up from the 2025 forecast. 2025 is not finished. It finishes in September. So 2026 will finish in September 26. And they were forecasting in January 1.865. Now, Commerce Secretary Howard Lutnick has said maybe these tariffs will bring in 700 billion, which would certainly, if that was true, certainly reduce their deficit for that year. But basically, every commentator on the planet has said that's rubbish. There's no way it's going to bring in that much. And the party I turn to try and get the most accurate forecast is something called the Tax Foundation Center for Federal Tax Policy, which has been around for 80, 90 years in the USA. They basically calculate and forecast the impact of taxes, and also they advise on what taxes should be, although the government takes no notice of that, really. But according to them, the tariffs will reduce, or rather increase tax revenues by 190.5 billion, which is a drop in the ocean compared with the deficit, provided or assuming that the 90-day pause that we're now in, which is now a 60-day pause, I think, left, assuming that 90-day pause ends as scheduled. So when this period of the pause on the tariffs ends, these very, very high tariffs will kick in instead of the 10% universal tariff that they've got at the moment. So if they raise those tariffs in 2 months, then 190 million will come in. But they said the problem with that is that it will have a negative effect on the US economy. So taking into account the negative effect on the US economy, it'll only be 140.8 billion. And that assumes at this point that there'll be no existing or retaliatory tariffs from Canada, Mexico, and EU, which we know are coming. So they say that figure will be reduced further. So obviously the impact of the tariffs is not going to have much of an impact on the government's deficit. It'll have a very slight impact. It'll increase their revenue slightly. But what's going to have a much bigger negative effect on the forecast by the Congressional Budget Office, the CBO, in their forecast of 1.8 trillion deficit, is assuming that the Tax Cuts and Jobs Act, which was put in place by Trump a few years ago, will expire on the 31st of December. It's set to expire, but Trump has said he wants to make it permanent. Now, according to this tax foundation's estimate, if it's made permanent, the 2026 deficit will be $500 billion worse than currently forecast. So taking the two together, we're talking about the deficit being 360 billion at best, worse than forecast. It could be a lot worse than that, which takes the deficit for 2026 above $2 trillion, which is a absolutely massive figure. And to put that in perspective, it takes the deficit to 6.5% of GDP. Let's just put that in perspective. 2025 deficits are going to be 6.2% of GDP, according to the Congressional Budget Office.
In this environment, gold has emerged as a key asset of confidence, reflecting both institutional and individual moves towards safety and stability. As central banks and private investors turn to gold in response to global economic shifts, could we witness the early stages of a long-term revaluation of gold's role in the global monetary system? Drop your thoughts in the comment section below. If you find this video informative, don't forget to support our channel and turn on notifications to stay informed about our latest videos. See you in the following video.